Mid-October 2025, Bank of America releases a report that makes precious metals traders do a double take. Their 12-month silver price target, $65 per ounce. That's not $38, not $45, $65. But here's the part that should make your jaw drop. Exactly 2 weeks after that report drops, China rolls out comprehensive export restrictions on silver. The timing? It's not coincidence. It's coordination. What Bank of America understood, and what most investors still haven't grasped, is that we just witnessed the end of an era. For over a decade, China has been the pressure relief valve for global silver markets. When prices climbed too fast, Chinese metal hit the market. When physical shortages emerged, Chinese refiners shipped supply. That valve just closed. Permanently. And if you understand what this means for Western industrial supply chains, you'll realize $65 isn't ambitious. It might be conservative. Let me walk you through something that most market analysts completely missed. Throughout 2024 and early 2025, China was shipping record volumes of silver to Western markets. In October 2025 alone, over 660 tons left Chinese ports. That's the highest single-month export figure in recorded history. Most people looked at that number and thought, China must have plenty of supply to spare. They were reading the data backwards. Here's what was actually happening. Shanghai Futures Exchange inventory data tells a completely different story. Chinese domestic silver stockpiles collapsed by approximately 75% between early 2024 and November 2025. We're talking about a drawdown from over 1,200 tons to roughly 300 tons. China wasn't exporting surplus. They were systematically liquidating reserves. Why would they do that? Because China needed time. Time to build domestic industrial capacity. Time to restructure their supply chains. Time to position their solar manufacturing, electronics production, and green energy infrastructure before cutting off Western access. That massive October shipment of 660 tons? That wasn't business as usual. That was the final contractual obligation before the export controls took effect on November 1st. Think about the strategic brilliance here. China spent 2 years flooding Western markets with silver while simultaneously building stockpiles through their internal supply chain. They kept us comfortable, kept prices reasonable, kept industrial buyers confident that supply would always be available. And then they pulled the plug. Now let's talk about what Bank of America actually knew when they issued that $65 target. This wasn't a forecast about mining output or solar panel demand. Those numbers were already public. What changed was their understanding that China was about to fundamentally restructure global silver supply. And here's how you know this was insider intelligence, not coincidental analysis. Look at what happened across Wall Street in September and October 2025. UBS raises their mid-2026 target to $55. BNP Paribas calls for $100 by year-end 2026. Goldman Sachs, Saxo Bank, TD Securities, all releasing reports highlighting physical delivery problems in London. When was the last time every major bank went bullish on the same commodity simultaneously? It doesn't happen. Banks compete. They take opposing positions on trades. Unless they all see something so obvious, so inevitable, that positioning becomes survival rather than speculation. What did they see? Shanghai Futures Exchange trading volumes contracting to 9-year lows. Chinese export data showing inventory depletion. The November 1st policy change approaching. They saw the chess move. And they positioned before retail investors even knew the game was being played. Let me explain how Western silver markets have operated for the past 20 years. London and New York trading operated on one critical assumption. Chinese supply would always be available as backstop. COMEX warehouses, London vaults, ETF inventories, they were all managed with implicit knowledge that if physical shortages emerged, China would ship metal. Price spiking toward $40? China floods the market with 500 tons and prices stabilize. Need 300 tons to settle contract delivery? Chinese refiners had you covered. That assumption just died. And most investors haven't realized what that means yet. The November export controls don't just limit future Chinese production. They effectively eliminate the 660-ton monthly flow that was keeping Western markets liquid. And here's the trap that's already sprung. That October shipment is gone. It went straight into the London squeeze that developed in September, where local premiums hit 15 to 20% above spot prices. The metal is already absorbed into existing supply chains. From December 2025 forward, Western markets are operating without their pressure relief valve. Think about what this means for industrial procurement. Solar manufacturers who built expansion plans assuming $30 to $35 silver. Electronics companies with supply contracts locked in at lower prices. Defense contractors requiring silver for advanced systems. They all built their business models on one assumption: supply would be available at reasonable prices because China would always fill the gaps. That world ended on November 1st. Here are the numbers Wall Street doesn't want connected. The Silver Institute's 2025 analysis projects a global deficit of 115 to 120 million ounces for this year alone. That's the fifth consecutive year of shortfall. But the cumulative damage is what matters. Over the past 4 years, global consumption has exceeded production by nearly 700 million ounces. Let me put that in perspective. Total annual global mine production is approximately 800 to 850 million ounces. The market has consumed almost an entire year of global production from existing stockpiles. Where did those stockpiles come from? Primarily China and India. And now? India implemented import restrictions in early 2025. China just shut off exports. The two countries that were covering the deficit just said, "We're keeping our metal." Meanwhile, industrial demand keeps accelerating. Photovoltaic solar installations consumed record volumes in 2025. The solar sector alone accounts for 20% of global demand. Every solar panel requires silver paste for electrical conductivity. There's no substitute that matches silver's efficiency at current technology levels. Add in 5G infrastructure, electric vehicles, electronics manufacturing, data centers, all structurally dependent on silver. And global mine production? Essentially flat at around 813 million ounces annually. New mines take 7 to 10 years from discovery to production. The math is inescapable. We're consuming more than we produce. The countries covering the gap are keeping their metal. And there's no quick supply response possible. China's November 1st policy wasn't announced through some casual press release. Throughout 2025, China's Ministry of Commerce issued escalating controls on critical minerals. April 2025, 7 heavy rare earth elements added to export controls. October, 5 more rare earths plus processing equipment. November 1st, silver joins the list of strategically controlled resources. The official language is explicit. These controls prioritize domestic needs and ensure national economic security. This isn't traditional trade protectionism. This is resource nationalism. China watched the United States weaponize the dollar, impose semiconductor export restrictions, and attempt to restructure supply chains away from Chinese manufacturing. Their response? Control the physical commodities that Western industries can't function without. Silver now sits alongside rare earth magnets as materials essential for defense systems, advanced electronics, and renewable energy technology. And Washington noticed. On December 6th, the U.S. Geological Survey added silver to America's critical minerals list. That's not routine classification. Critical minerals are materials deemed essential for economic and national security where the United States lacks adequate domestic supply and is dependent on potentially hostile foreign sources. Same category as rare earth elements, lithium, and cobalt. America's defense and industrial sectors depend on a metal whose primary supplier just nationalized supply. Let's run the numbers that institutions are trading on right now. Silver currently trades around $52 to $60 per ounce as of December 2025. Gold is above $4,000. That puts the gold-to-silver ratio at approximately 75 to 85 to 1. Historical average over the past century? Around 60 to 1. During precious metals bull markets? The ratio compresses to 30 to 40 to 1. If gold stays at $4,000 and the ratio simply normalizes to 60 to 1, silver trades at $66. That's Bank of America's target, and it requires zero supply shock, zero additional demand panic. Just mean reversion. But here's where it gets interesting. If gold continues toward the $5,000 level that Bank of America also forecasts for 2026, and the ratio compresses to even 70 to 1, silver hits $71. At 60 to 1 ratio, silver reaches $83. At 50 to 1, which is common during acute supply crunches, silver trades at $100. exactly where BNP Paribas sees it by end of 2026. These aren't speculative projections. These are mathematical relationships that have held across centuries of precious metals markets. The only thing historically preventing ratio normalization has been availability of physical supply to satisfy industrial demand at suppressed prices. That availability just ended. Here's how institutions are modeling the next 12 months. First quarter 2026. Silver consolidates between $55 to $65 as markets digest China's export restrictions. Western ETF inflows continue as investors recognize supply constraints. Bank of America's $65 target represents the base case for this period. Key catalyst? January industrial demand data showing supply chain stress in solar and electronic sectors. When manufacturers start reporting project delays due to silver procurement difficulties, the market reprices from China might ease controls to this is permanent. Second quarter 2026, supply tightness becomes undeniable. Chinese export data confirms monthly outflows dropped from 660 tons to under 100 tons, and that's only pre-existing contracts. London and New York physical premiums spike. Silver trades $70 to $85. UBS's $55 target gets breached. Their secondary scenario of $100 plus enters active consideration. Key catalyst. U.S. solar industry publicly blames supply constraints for missing renewable energy targets. Political pressure to solve the problem accelerates, but there's no quick solution. Third quarter 2026. The scramble for physical intensifies beyond industrial users. ETF inventories come under pressure. Silver breaks $100, reaching BNP Paribas' year-end target 6 months early. At this stage, real yields remain deeply negative. You're getting minimal interest on cash, inflation is running above 3%, and you're holding an appreciating physical asset with industrial demand that can't be satisfied. That's when momentum accelerates beyond fundamentals into speculation. Fourth quarter 2026, two scenarios emerge. Conservative case. Silver consolidates between $90 to $110 as some industrial substitution occurs. Companies reduce silver content in products. Electronics manufacturers redesign components. Recycling increases. These are slow processes, but they happen when prices justify the investment. Aggressive case. If Chinese exports remain completely restricted and U.S.-China trade tensions escalate, silver enters blow-off territory toward $150 plus. This isn't fantasy. Adjusted for inflation, the 1980 silver peak of $50 equals approximately $180 in today's dollars. The blow-off scenario requires panic buying from industrial users competing for the same limited supply. When solar manufacturers, defense contractors, and electronics companies are bidding against each other, price discovery breaks down. Here's what most people are missing about the timing. China implemented these export controls on November 1st, exactly 75 days before the January 20th presidential inauguration. That wasn't random. Beijing is establishing negotiating leverage before trade discussions begin. Silver is now a bargaining chip in U.S.-China relations. And when commodities become geopolitical weapons, prices don't follow normal supply-demand curves. They spike based on political tensions and strategic positioning. Add in the Federal Reserve's December 2025 commitment to $40 billion monthly Treasury purchases. That's $480 billion in additional liquidity injected into markets through 2026. Combined with rates at 4.00 to 4.25% while inflation remains above 3%, real yields stay negative. Negative real yields are rocket fuel for precious metals. From 2008 to 2011, under similar conditions, silver went from $10 to $48. That's 380% in less than 3 years. We're starting this cycle at $60. If silver simply replicates that percentage move, we're looking at $220 plus per ounce. Most investors won't believe those numbers are possible until silver is already at $150. The institutions positioning now, Bank of America, UBS, BNP Paribas, Goldman Sachs, they've already done the math. They've seen what happens when the world's largest silver exporter stops exporting. They've modeled the supply deficit. They've calculated ratio compression. And they've positioned accordingly. The synchronized price target upgrades in September in October 2025 weren't coincidental. They were the institutional front-run ahead of a supply shock they saw coming. Bank of America's $65 call isn't where this ends. It's where institutional repositioning begins. When major bullion banks that historically profited from silver price suppression publicly announce bullish targets, they're not trying to help retail investors. They're announcing they're no longer fighting the trend because the mechanism they used to suppress prices, infinite Chinese supply, just disappeared. The warning signs are everywhere. The U.S. declaring silver a critical mineral means Washington acknowledges we're dependent on a potentially hostile power for strategic supply. That's not market analysis. That's admission of national security vulnerability. China's November 1st export controls weren't about trade policy. They were about establishing leverage in a new era of resource competition. The Federal Reserve injecting $480 billion in liquidity while maintaining negative real yields creates the perfect environment for precious metals appreciation. And the supply deficit that's been documented for 5 consecutive years just got worse because the valve that was covering the shortfall permanently closed. History shows most investors get interested in commodities after prices have already doubled. They wait for confirmation. They want consensus. By the time mainstream financial media is running daily silver coverage, the institutional players are already selling to late retail buyers. Bank of America told you where they think this is going. Minimum $65. What they didn't tell you is that's just the first target in a much larger repricing cycle. The chess move happened on November 1st when China shut off exports. Bank of America announced the consequence on October 16th, before most people understood the game was changing. The institutions that saw this coming have positioned. The industrial users who depend on silver are about to discover their supply assumptions were based on a world that no longer exists. And somewhere between institutional repositioning and industrial panic, there's a repricing that reflects the new reality. Silver is no longer an abundant industrial metal with suppressed pricing. It's a strategic resource under Chinese control with constrained Western access. That's not prediction. That's mathematical consequence of what already happened. Bank of America's $65 target isn't bullish cheerleading. It's acknowledgement that the old playbook broke. The question isn't whether silver reprices. The question is how far, how fast, and whether you recognize the signal while institutions were still telegraphing their moves.